I probably had 100 coffee meetings where 100 times somebody told me no. And I don't drink coffee, so I'm an anti-caffeine person. So you can think about how painful that was, not drinking coffee and also hearing the word no. It was the hardest $1 million that I ever raised.
Jilliene, welcome to the show today.
Thanks for having me.
So you grew up in a household of entrepreneurs. What was that like early on?
Yeah, I did. So, we started talking about real estate and business at the dinner table. I was like 2, 3 years old. My dad was an entrepreneur. My mom was an entrepreneur, grew up in a big family. And so I feel like I sort of grew up in this really unique environment where I learned a lot about what I didn't want to do. So my dad was in the import export business. He was manufacturing physical products in China, shipping them into the US. And I'll never forget, I said, I never want to do something with physical inventory. So then I went into real estate, right? Which are like, massive buildings, but they can't be shipped. So non-shippable buildings.
Yeah, that's pretty cool. I grew up in a family of non-entrepreneurs. In fact, I don't even know an entrepreneur was a thing. So I'm super jealous, and I'm trying to change that with my kids as well. Now you have a fantastic background, but you have a background in banking. But I'm less interested in that. But I'm interested about your startup days from Realty Mogul. What was that like? Like, what was the startup like?
Sure. So I started the company in my living room, and I'll never forget. It was the middle of summer. I didn't have air conditioning, and so I would pull the curtains through the entire room just to try and get some reprieve from the heat. But it was that time. It's so exciting. Like I'm so nostalgic for it now. But it was the time where, as a CEO, you did everything, right? You weren't really a CEO. You were really, chief janitor and chief everything else. So I was calling clients directly. I was, sourcing all the real estate companies that we were doing business with. If there was an ad that was going out, I was writing that ad. If there was an email that was going out, I was writing that email. So it's really this, really in the weeds time where there's no employees, right? And when there's no employees and there's no people to help you build, the team and the company, you're really in the weeds doing everything. I used to call every single new sign up on our website and personally welcome them, but I didn't want them to know that I was the CEO. Right. So I wouldn't identify myself as the CEO. I would just say, hi, I'm calling on behalf of Realty Mogul. Thank you so much for signing up. If you have any questions, feel free to call us. But I made, thousands of welcome calls in the early days.
People listening to this, they want to do, they want to start and own in their multifamily real estate and become financially free and just go out on their own. And so anyone who leaves their corporate job and starts their own company, they kind of go through a similar thing, right? There's doubt, self-doubt, there's some setbacks. What were some of the challenges that you faced early on when you left your job and started Realty Mogul?
Yeah, so I invested my own capital to start the company, but that only went so far, right? And so we needed capital for the business, right? Not for the real estate transactions, but for the operating company. And so I said, okay, I'm going to go out and raise a seed round. And it was going to be $1 million. So the idea was to go out and raise a seed round of $1 million. I probably had 100 coffee meetings where 100 times somebody told me no. And I don't drink coffee, so I'm an anti-caffeine person. So you can think about how painful that was, not drinking coffee and also hearing the word no. It was the hardest $1 million that I ever raised.
It's a good thing you don't love bourbon, because that would have been even more challenging. 100 bourbon meetings.
True. True. But it was the hardest $1 million that I've ever raised. I mean, I've now been involved in, over $1 billion in capital raising. And had I not stuck it out to raise that first $1 million, the company wouldn't exist. And it's kind of the advice that I give a lot of entrepreneurs who ask me for advice. I say, just keep going, right? The only person that can kill your business is you. But just keep going, right? And keep persevering and keep fighting. And so, I think it was the 103rd meeting that, one of the investors said, yeah, I'm in. And then from there, it was a lot more smooth sailing on that first $1 million.
And this is such great advice. And this is one thing I noticed as well for people, is they have to stick with it. But man, 102 unsuccessful meetings. It's a pretty bad record, Jilliene. I mean, holy moly. How did you get to that 102nd? Like, why did you even go past like the 12th, right? Like why did you keep doing it?
I think I really believed in this idea, right? I really believed in this idea of democratizing access to real estate. And so, we've always been a mission-oriented company, right? We don't think that real estate should strictly be available to, the folks who know somebody at the country club, right? The world has just evolved so far beyond that. So I think that I had confidence in the idea. But probably I was stubborn and naive. This was 10 years ago. I was much younger, much more naive. I always ask myself, like, if I was faced with that again today, could I still do it? And the true question is, I don't know. Right. But 10 years ago, I didn't know any better. Like I didn't, I was just so naive that there was never a doubt in my mind that I was going to do it. It was just a matter of, how much pain and suffering can I go through?
It's so funny because I feel the same way about my first deal. I would never do that first deal because we used a nice word, naive. I was ignorant. I had happy ears on, and I was so confident I could do that. And you do it again, you're like, I would never do that again. That's so
Yeah.
it's so funny. But talk about what Realty Mogul is, because we've kind of hinted at, and some people may not know what Realty Mogul is, and what is it? What do you do?
Sure, sure. So we're an online platform for real estate investing. On one side of the platform, we've got real estate companies. And on the other side of the platform, we have investors who are looking to diversify into real estate. So those investors can come to our platform and browse a whole variety of real estate investments, from multifamily, office, retail, industrial, self-storage, cold storage, mobile home parks, kind of the list goes on. And real estate companies can use our technology and use our administrative services to access capital for their offerings. So, we've built this marketplace where investors can be connected to real estate deals, real estate companies can be connected to investors. And really the mission is to expand access to real estate investing. I think it's a really critical part of a diversified portfolio. A lot of folks in the country, have really easy access to stocks and bonds, but when it comes to private real estate investing, they sort of don't know where to go, right? And so we really wanted to solve that problem and make real estate much more accessible.
And there's quite a few syndicators out there. You're a little bit different because you're connecting, and I know you're very involved in the markets to a degree. But what makes Realty Mogul different than everyone else? Because it's such a really modernized, chic platform. But I'd love to hear it from you.
Yeah, it's maybe a strange question, but I think it's twofold. One, like, we always talk internally about perfect the basics, right? So if someone calls us, like, pick up the phone. Right? Don't send that to voicemail. If somebody emails you, respond to that email within one day, even if your response is, hey, I'm working on it, I don't have the answer yet. Right? So I think that it's that level of client service. We also believe in white glove service. So every accredited investor that comes on the platform gets a dedicated investor relations representative that they can reach out to directly if they have any questions about the platform. So we're a digital platform, but we also still really believe in human connection. Right. And in having a dedicated person that you can talk to, and being able to have an intelligent real estate conversation. We host webinars for every single deal. So we're very focused on education as well. So even if someone, doesn't want to make an investment with us, I just deeply believe that people should be educated about real estate investing, which is why I do, podcasts like this. And they're a lot of fun to, help build more awareness. But I really think that it's our culture, it's our people, it's the white glove service, that sets us apart from many of the other platforms in the space.
Those are back to basics. It's kind of a lost art, like the handwritten note, for example. I love that. But talk about how it's different to invest with Realty Mogul versus, investing in a private placement, in a syndication, kind of like what we do. What are some of the differences?
I mean, there's probably not very many differences, right? The offerings that are posted on the platform are
the
private syndications.
The minimum investment, for example, right? I mean, ours in the meantime is $100,000, most are minimum $50,000, and yours is substantially less than that. So it opens up, like you said, real estate to almost the masses.
Right. I mean, yeah, typically the minimums are between 25,000 and 35,000. So the way it works on the Realty Mogul platform is that you can either choose to invest in an individual deal. That is a syndication, right? So crowdfunding, in my mind, is just a synonym with syndication, right? You're pooling capital together with other investors that you may or may not know. So those are individual transactions. We also have 2 real estate investment trusts, or REITs, on the platform, and those are diversified pools of assets, right? So if you want to buy a specific apartment building, you're going to buy into an individual asset. If you want to buy, a pool of apartment buildings, or a pool of apartment buildings and retail and office, and you want to get broader based diversification, we also have 2 REITs, that allow investors to do that.
So REITs, okay, let's bring that up, because a lot of people confuse investing in syndications or with Realty Mogul and a REIT. How is a REIT similar or different to real estate, right? Are these publicly traded REITs? Like how are they different? Why would someone invest in one or the other?
Yeah. So look, if you're investing in an individual asset, it really gives you control, right? You have total control over the selection process. You can pick investments in a specific location. Maybe it's a place that you live. Maybe it's a place that you know well. And you also select a specific property. So maybe you want exposure to office or retail or industrial or self-storage, et cetera. When you invest in a REIT, on the other hand, the Realty Mogul team is making that selection. So our team has discretion over which assets that capital is going to go to invest into. So you lose a little bit of control as an investor, right? If you want control, you're probably better off going in an individual deal. If you want to sort of set it and forget it, you might be better off going into, one of those REITs. But the REITs tend to be diversified. So you can get exposure, across markets, across different business strategies, in some instances across, different property types. We have one REIT that's strictly apartments. It's called the Apartment Growth REIT. And we have another REIT called the Realty Mogul Income REIT that's more focused on diversified product mix. So it has some office, it has some retail, also has some apartments in it. So, and then the other difference is the tax treatment. So if you're investing in an individual deal, you get a K1 that will allow you to write off, depreciation off of your taxes. If you're investing in the REITs, you get a 1099 that reports, your dividends earned and the capital gain, distributions, if there are any that were paid throughout the year. And then REIT shareholders can also deduct 20% of the taxable REIT dividend income. So, there's some tax benefits there as well, but, difference in tax treatment, difference in controls, difference in the amount of sort of energy and effort that you have to spend, doing your own due diligence as well.
And so how does this fit into, so if I'm an investor, and how does this fit into kind of a more diversified portfolio? How is this complements, let's say, equities? Most people, they just invest in equities. How should they think of this in their portfolio?
Real answer is going to be, it depends, right? So, a lot of folks are working with an investment advisor or otherwise to kind of figure out what is the best breakdown of their portfolio for them, right? And, you can take the old Warren Buffett approach, like invest in what you know, right? I'm personally way over allocated to real estate because it's what I know. It's what I, live, eat, breathe, dream in. It's the language that I speak. But other investors, could be in other asset classes, right, that they may know well. So I think it really depends on the investor. And I think getting clarity on, like what's your risk and reward profile, right? What's your appetite for risk? How much do you want invested in equities? How much do you need liquid, right? I mean, one of the downsides of private real estate investing is these are illiquid assets, right? So, I mean, we know the business plans might be 5 years or 7 years or 10 years. So I always say to investors, like, please don't give us your dinner table money, right? Like, don't invest with that capital. This is, long-term, kind of real estate allocation. It's not going to be liquid. So I think figuring out, what's the liquidity need? And also what kind of duration are you comfortable with? Are you comfortable with 3 years? Are you comfortable with 10 years? And then I think beyond that, it's getting a really deep understanding of one's risk and reward profile. So, if the stock market goes up 20%, and you're super happy, but if the stock market goes down 20%, are you going to fall apart, right? Or are you going to be able to hold through that cycle? It's really no different in real estate, right? If you think about, the different ways that you can invest in core deals, you can invest in value add deals, you can invest in opportunistic deals. Opportunistic tends to be, the highest return profile and the highest risk. You can think of that as, like development deals. Value add tends to be, in the middle of the risk profile. You can think of that as like a, value add apartment building where you're going to invest $10,000 to do carpets and paint and that kind of thing. And then you can think of core deals, which tend to be more stabilized in, stronger markets. Those are very different risk and reward profiles, and they're still within the context of real estate. So I think an investor understanding where do they want to play, within what risk profile, and then what percentage of their capital do they want to allocate to those strategies?
So my obvious question following this is, how did you decide on first of all, why did you choose to add REITs into the platform? And then how do you vet and decide who you work with? Sure.
So, I think in building companies, one of the most critical things is to listen to your clients. Right. So there's two approaches in building companies. One is the, Henry Ford approach, which is you can have any car so long as it's a, Ford and it's black, right? Where you're building like totally homogenous, product. And then on the flip side of that is listen to your customers. I'm not Henry Ford, so we listen to our customers. And we just had so many people saying, hey, I don't want to pick and choose each individual asset. I want someone to do that for me. Can you please just build me a vehicle where I can make one investment, get diversification, and sort of set it and forget it. So that was the creation of the REITs, or sort of why we created the REITs. As far as how transactions get on the platform, real estate companies use our technology and use our services to raise capital for their offerings. So the offerings on the platform are, these real estate companies who come to us, but we have minimum qualifications. So we're, looking at the track record of those real estate companies. We're running criminal checks, we're running background checks. And then we also have quality control measures. So we're looking at environmental reports, we're looking at property condition reports. What we're trying to do is mitigate, any risk of fraud, any reputational risk. What we can't do is guarantee anything, right? So we can't guarantee returns, we can't guarantee outcomes. I mean, so much of that is just so far out of our control. But we have minimum qualifications and then quality control standards for every transaction.
What is your outlook for the market? And obviously, split it in real estate and different classes of real estate and also in equities, right? Like, what's your general outlook?
Yeah, I mean, what do I think is going to happen? So let me start by saying, I'm not a fortune teller. So I will likely be, wrong than I will be right. And I'd probably be, in a different business doing something else if I was a better fortune teller. But if I look at the macro environment right now, I am very concerned about the growing inequality between the wealthy and the not wealthy. And the reason that I start there is that the pieces of the economy that are being most impacted by inflation right now are food, energy, and housing. And it is getting more and more expensive for the average person in this country to be able to live a, quality or either rational life because of the cost of food, energy, and housing. And what I really worry about is that given this inflationary environment, I don't think that the Fed can fight inflation by increasing rates. It's going to make an impact, but I really think that the core of the issue is the supply chain. Right? We turned off the supply chain during COVID. It's been disrupted for 2 years. It's probably going to take about 2 years to come back. And that 2 years probably started 3 to 6 months ago. So we're probably 18 months out from the supply chain normalizing, which I think will in and of itself really help with inflation, in addition to the Fed measures. But the Fed can't fix the supply chain by increasing rates, right? In some respects, they may further disrupt the supply chain by increasing rates because it makes it more expensive to, finance factories or buildings or new trucks or whatever it is that these companies need to fix the underlying supply chain issues. So the Fed is reactive. They're rarely, if ever, proactive, and they typically overshoot. So what I think is going to happen right now, and again, not investment advice, please don't trade on this, do your own research, but what I think is going to happen is the Fed is going to overshoot. I think that it's going to create a tremendous amount of social unrest because people don't have food, energy, and housing. I think that is going to lead to increased crime, which I'm really concerned about in this country. And I think that the Fed is going to react the other direction. We're going to see more quantitative easing and we're going to see rates come down quickly. Now, if that happens in 18 months, 24 months, 36 months, 48 months, I'm not smart enough to know, the exact timing. But what that means is I think that as you see dislocation in this market, whether it's equities, whether it's real estate, anytime you're investing, you'd rather invest near the bottom than near the top. Right? The big question is, how long is it going to take to get to the bottom? I think this is going to be pretty fast. I mean, when you look at the 08-09 crisis, it took us until 2012 to see the bottom of the real estate market, almost 4 years. You look at what happened in COVID, the bottom of the real estate market, COVID hit March 2020. The bottom of the real estate market, that cycle was probably July or August 2020. I mean, it was so fast because of the dissemination of information, because of social media, because of how quickly the VIX volatility index moves, how quickly sentiment changes. I mean, one of the metrics I love to track is how many people are Googling recession. Have you guys seen the stats on this?
No, what are
They've
they?
just skyrocketed.
Yeah.
I mean, in the last 30 days, they've just totally skyrocketed. So we're convincing ourselves to go into a recession, right? I mean, these things are self-fulfilling, right? So, that's personally what I believe will happen. I think there's going to be tremendous opportunity to acquire real estate, in this economic dislocation. I think that it'll be faster than historical inflation, or rather faster than historical downturns because of social media, because of some of the issues that I think that are going to present themselves to the Fed and there being a retrenchment of Fed policy. The other thing you have to think about is just how much debt the US government has. So having high rates for an extended period of time is not a good thing for the US government, right?
Absolutely.
Like one of my favorite slogans is don't fight the Fed. When I think about those things, I think it's going to be a really, really interesting time.
As far as where we're at right now, it feels a lot like we're in the middle of kind of like when COVID first started, honestly, just the sentiment of the market. It's like people are really cautious. We're seeing less people willing to go out and invest dollars, which is surprising to me. We're seeing banks actually with less liquidity. I just had a call this morning, and I guess a lot of the people are just spending money on everyday living or something, but there's less liquidity inside the banks.
We think about the world as, can you pick up really high quality assets and really high quality markets during this downturn, right? In an environment where you wouldn't be able to pick up that piece of real estate prior. And I think there's going to be opportunities to do that. Now, on the flip side, do I want to be buying, tertiary real estate in a market with no liquidity? Maybe, right? And the reason I say maybe is that if those cap rates adjust so wide, if the cap rate spread between that market and a secondary market or a primary market adjusts, right? I wouldn't do that in today's market, but if that adjusts, and we're seeing it adjust quickly, right? But if that adjusts, that liquidity is going to come back, right? People forget when they're in the heat of a recession or in the heat of a downturn, like this is cyclical. It's always been cyclical. It will always come back. You don't know how fast it's going to come back. You don't know to what extent it's going to come back, but these are cyclical times. And so I think that the number one inhibitor of good investors is emotion, right? We're emotional beings. Human beings are emotional creatures. But if you can set that emotion aside, there's going to be tremendous opportunities, but there's also going to be some really terrible opportunities, right? And so that's where I think the knowledge and the expertise makes a big difference.
Yeah. And so I think there's this side where it feels like everybody's being emotional right now. To me, at least, it's like a lot of people are sitting on the sidelines, like sit and wait. And so then there's that part of me that's like, all right, now it's time to pounce. But I think keeping the fundamentals in play of looking for opportunities where there's maybe assets in areas that, like you said, you wouldn't normally have access to. They're in areas of the market that now all of a sudden they're popping loose, and before they were just going to sit for a long time. What I've been seeing at least is a lot of the lower class areas. So maybe the D class, they're getting overlooked by lenders and by purchasers. There's a ton of inventory hitting the markets right now. And the ones that are trading are only those really that are highly desirable and well-located areas for the most part. Just generalizing, I don't want to be too specific on it, but we're seeing so banks don't want to lend on those in the bad areas necessarily, or people don't want to buy them at the same pricing. You're seeing a lot of retrades and all that stuff. So that fear is there. The question is really, how long is it going to last, and how long are you still hunting at this point? And so I think what you're saying is, it's all specific. You have to look for individual opportunities depending on where you're at, and it's really specific depending on what you're looking at, right?
And also your time horizon, right?
Yeah.
I mean, if you're looking to go in and do a value add deal and flip it in 18 months, probably not the right time. If you can underwrite that to a 10-year hold, or you can have an opportunity to exit the next 10 years, likely.
So I'm sure you're really in tune with the debt. You have your pulse on what's happening in the debt markets right now, like I do. What are you seeing on that front, and how are you pivoting around what's happening in the market?
The biggest issue is that the increase in rate is bringing leverage down, right? The DSCR coverage ratios are harder to meet because your debt is more expensive, right? So as a result, you're seeing leverage come down. So where historically we would see, on average 70 or 75% leverage on a lot of these value add deals, they're now coming in at 65%. So, you need more equity, right? In some respects, like our business is even more important in an environment like this, because we have real estate companies that are coming to us and saying, hey, I want to use your technology because all of a sudden my, equity requirement is $4 million or higher, or $6 million higher, whatever it may be. So you're seeing increased equity, which in some respects is good, right? Anytime you bring leverage down, you're de-risking that transaction, with the caveat that today's a really weird environment because you're borrowing it with dollars today and you pay them back with, inflated dollars tomorrow. So I actually like leverage in today's environment. But I think that you're seeing lower leverage. I think that you're seeing, a lot of companies go out and start using preferred equity, where historically there wasn't a very big preferred equity market, because if your senior lender can get to 75 or maybe even 80% loan to cost, there's no room for preferred equity on that cap table. Today, I think there's room for pref equity on the cap table. So you're seeing a lot of, deals go to pref equity and having that be a piece of their capital stack. You're seeing other groups, have lower leverage, raise more equity, and then the returns inherently are coming down. And then you're also seeing a lot of the, non-traditional lenders who really struggled the last, 5, 6, 7 years when cash and liquidity were very high, start to be a lot more relevant, right? So like in the example of what you're talking about, Garrett, where you're going to buy a Class C or Class D property, run down, high crime, not a strong tenant base, your banks aren't going to do that trade today, but your private money lenders are. And frankly, if the banks are priced at 5 or 6% right now, and your private money lenders are at 8 or 9, there's not as wide of a spread there as there used to be.
Yeah, I love that analysis as well. It's just a lot of the stuff that I'm seeing the same way. And the pref equity, I didn't even think of that. That's such a true statement. It's like people still need to try to get the leverage. And, pref, maybe it's more hoops to jump through to get the pref equity, but they're like, well, I'd rather do that than not do the deal. They can't raise it otherwise. So I think that's a really, really sharp observation. Jilliene, it has been so great having you. How can people get a hold of you if they want to find you?
Yeah, so feel free to go to our website. We're realtymobile.com. It's free to sign up for an account, free to start learning. You can watch a ton of webinars on, live real estate deals and hear 10, 20 different operators answer, questions like these, right? How are they navigating this environment? Where do they see sort of the deals that they think are worth doing? And then if you want to find me personally, I'm active on LinkedIn. So feel free to drop me a note there. I'd love to connect.
Super smart, really, really intriguing real estate investor and entrepreneur, Jilliene. Thank you so much for being on the show.
Thanks for having me.